Hi everybody, TGIM, and welcome to week 29. I am joined by my magnanimous colleague from our Shanghai office, the very talented Forrest Mao, who will be covering the Greater China kind of sector from a global sales trading kind of perspective. As always, everything we do cover here on this call is solely our views and opinions. These are not trading nor investment recommendations, nor should be construed as advice. So just kicking it off, the basic theme that we've been talking about here since that Fed June 19th meeting has been the fact that U.S. monetary is the most important thing now. I think now, as we construed basically that this is going to become a third quarter consensus thing once people kind of unravel themselves from U.S. kind of China trade relations and what's been going on kind of there. Obviously, that's easier and sexier to kind of talk about, but at the end of the day, the most important beat in global macro really is the U.S. monetary policy and the ripples, the pace, and everything it basically sets for the rest of the globe. So over here, I'm basically just highlighting that it's all really about July 31st, which will basically be August 1st, early doors, Thursday, Asia time. But there's currently a pricing of 100% probability. And that is basically based on 80.5 being 25 basis points, and about 20% of that being 50 basis points. The blues here, the 97.5 and the 2.5, basically shows you what the probability was last Monday. So this was pre-FOMC minutes. This was pre-Powell testimony. And if you recall, previously we'd also had the market pricing in more of a 50 basis point cut for July. I think at one point we were up to about 30%, maybe even a little bit more. So you can see kind of this maybe will explain to a few of you the whippy market that we kind of had last week, not just in regards to kind of yields, but obviously precious metals, the dollar, and kind of FX. A lot of frustrations that we keep hearing from clients, as well as also some of my peers who are sitting and trading on investment bank desks, hedge funds, family offices, and so on. It's been a very hard market to consistently kind of make money in. It's just kind of the mean reversion regime that we're kind of in, and this is even for the scalpers, the people that kind of just really just kind of day trade as a whole. Even they have been struggling. So again, we are 100% priced for a cut on July 31st. About 80% of that is implying just one 25 basis point cut. About 20% of that is implying two, and of course that got a bit kind of complicated last week given some of the econ data that kind of came out. Predominantly what we had was a CPI beat that kind of came through towards kind of the back end of the week. So this was actually post FOMC kind of minutes, as well as the initial kind of power kind of testimony as a whole. Now, I don't think this is enough, obviously, to reverse kind of anything, and I think it's, it just doesn't get easier, you just get stronger, to quote Kai Green at the end of the day. We only move in one way, in my humble opinion, in regards to kind of Fed policy, and it's going into kind of, I believe, a cutting regime, and for me, it's just a question of the magnitude of the cuts and the speed, because I don't think it's a GFC scenario where we having growth fall off a cliff. And I think a lot of you will see, even from the recent PMIs and ISMs that we got out of the U.S., it is still doing quite well. And of course, relatively to the rest of the world, it is doing exceptionally well. So that's kind of the viewpoint that I still have, and that's why I think for both this Macro Monday and quite a few of the others, there's not going to be anything too much kind of new, but we'll obviously go through a few of the different scenarios to kind of keep abreast of. So that was pretty much FOMC minutes, as well as kind of Powell at the end of the day. And then we also had Bank of Canada, which, to be honest, from my perspective, was a pretty neutral statement, meaning in a world where the Fed is dovish, that is hawkish on a relative basis, and still think that Bank of Canada and the loonie is part of team divergent for now, regardless of how strong the data has been in Canada and the loonie as a whole. I actually think dollar loonie can go down to high kind of 20s. To be honest, I think there's a very decent chance that we break these 130, 33 kind of levels where we are. Appreciate that's maybe a big move or call, given the fact that we have consecutively just been strengthening kind of there. But, that's my view at the end of the day. I think at some point, Paulos does have to fold and follow the Fed, but I'm not quite sure that is going to be maybe the next meeting. I think maybe back end of third quarter, early fourth quarter is worth thinking about. What I do like about this, and I've been speaking to a few of you on, is whether or not buying Canadian bonds or Canadian bond futures is a very kind of convex kind of trade in the sense of the downside is limited, i.e. the probability of Canada moving towards hiking versus, let's say, the rest of the world is very, very small. And even if they did, probably the most they can manage is maybe 25, maybe 50 basis points if you really wanted to kind of be kind of extreme on that kind of view. So kind of food for thought there, and I think that could be one of these very kind of long-term structural kind of trades that you could have kind of in the portfolio for those of you who have that much more of a kind of a medium to long-term kind of perspective, so to speak. Equities, continued, was mixed, but definitely still continuing up higher in the U.S. We are making new highs, and I'd be telling people to watch out for the potential kind of breakout higher. Fixed income, funnily enough, wider for the week, but obviously we've had a very, very strong move down over the last previous weeks. I think, again, most of this is a function of kind of positioning, to be very honest with you. FX, dollar weakness, maybe a little bit less of a surprise given the big prior week move that we had, which was well over 100 kind of basis points. So potentially a combination of mean reversion. And for those of you that caught the COT report from Ole, remember, there was a delay, so we didn't have it on last week's Macro Monday, but there was a very big pullback in regards to kind of U.S. dollar kind of positioning. On the commodity side, it fared quite well, especially on the likes of energy, likes of nickel, up close to kind of 8%. Precious metals, even though they finished up for the week, was very, very tough to trade. We kept kind of going back to that 1380-ish to 1390, 1400 kind of levels of gold, which I think is the key kind of support, and for silver, kind of that 1490 to 15 kind of levels, which we've advocated kind of many times. That still seems to hold kind of true. And I guess the question, though, is if we do have a little bit of a repricing in yields kind of going back up, even if it's just temporary, what is the effect on that on precious metals? For me, the big levels really here are going back to kind of June 18th. And just off the top of my head, I think that is around 1487 on the likes of silver and around 1340 on the likes of kind of gold. Like, those to me are really kind of the big kind of levels that will potentially kind of challenge this very high kind of conviction not just quarter, but multi-year kind of view that I have in regards to kind of gold and silver. And then, of course, we have to kind of keep watching things like U.S. kind of CPI as a whole there. Vol, again, continues to go lower. I still think structurally in this cycle we will see all-time lows in vols, just as we will see all-time lows in kind of yields. They kind of have to go kind of hand in hand. Key risk, as always, is more hawkish kind of central banks, inflation kind of rearing its head, et cetera, et cetera. One just extra note on the EM side of things was this big kind of reversal we had in dollar tri initially. So we had gapped up last Monday, if you recall, with the announcement of the central bank governor being fired, and it quickly basically retraced kind of lower, which is quite interesting. And then we kind of reversed towards kind of the back end of the last week. Again, not back to the same levels, but this is on the risks that we had highlighted last time of them starting to now, and when I say them, I mean Turkey starting to receive the delivery of the Russian missile systems and the implications of that, being a member of NATO, and more importantly, with the dealings that they have with the U.S. in regards to kind of airplanes and training and so on and so forth. Obviously, mixed bag signals with the Pentagon saying one thing and saying sanctions should be coming, and so far we've not heard anything from Trump. And if you recall, Erdogan said that Trump said that there was basically going to be no kind of sanctions. So that is definitely a live and key one to just kind of keep on the radar from just an EM kind of perspective. COTS, again, previously it really was all about the move 2 weeks back. The actual last week, not too much of a move from an overall kind of positioning in regards to kind of dollars. I will point something out. I think this is blatantly wrong. Despite having been an bear on Aussie dollar, I believe since like February, March last year, when we were kind of 78 cents. I actually think that the big kind of chunk of the move, or should you say the meat on this kind of trade has turned. I would expect by the end of this third quarter, the market to actually be long Aussie, and I think this could actually turn over in kind of the next kind of few weeks. It just feels to me that the convexity is more kind of towards the upside than anything, and that's both from kind of a positioning kind of basis, as well as also just the fact that being short Aussie dollar is just not as clean and as pure a trade as it kind of once was, and at the end of the day, it's had a magnificent kind of run for those of you that actually have been holding that since March of last year. That's kind of one of those kind of key high conviction kind of macro trades. Worth noticing that the euro longs are nowhere kind of close to some of the extremes that we've had over kind of the last 1 year as a whole. Yes, it looks like definitely my views on Loonie are consensus given kind of the positioning, but again, that does not mean it's wrong at the end of the day. And this is interesting to kind of note the positioning here on the real, for instance, what's happening in the ruble, what's happening in the peso, and you all know kind of my views on structurally being long EM high yielders versus short the US dollar. And again, on commodities, again, overall from an overall kind of positioning, not too much kind of delta. So what is the upcoming week about? Like I said, like at the end of the day, to me, most of these things are irrelevant in the face of coming towards that kind of July 31st Fed kind of cut at the end of the day. That's the most important thing out there. But on a week-to-kind-of-week basis, we will be hearing from some central banks this week on the emerging market side, which could be interesting in regards to maybe giving us a taste of how they feel they should be acting if we have now a more dovish kind of Fed. So watch out for decisions from Indonesia, where they've actually kept rates, I think, a little bit more on neutral rather than, let's say, cutting, which may have surprised kind of a few people. We also have South Africa, where we know there's been a lot of pressure, potentially again also on central bank independence there. China GDP always is a key one for focus. We have minutes from the RBA. Always a high mover is the Oz jobs data. Again, my viewpoint here is on the RBA is, they've cut 2 times in a row, and now for the very least they'll be kind of on the sidelines. And I'm also hearing from some of my most kind of trusted and respected peers that I have down there that the government is actually being a lot more kind of proactive than was actually initially kind of expected. And from a G10 perspective, actually the Australian government has, one of the best kind of balance sheets out there. There's very, very little debt to GDP from a government kind of perspective. So there's definitely a lot of kind of dry powder. And if they actually start to put that into action now, they should be able to weather kind of the end of this cycle a lot better than a lot of other kind of people. We've also seen reports of kind of housing and auction rates actually improving post now the kind of 2 cuts that we've had. So again, I still think that the consensus view here is bearish and negative, and we can obviously all understand the reasons why that kind of is. It's not stuff that's being solved kind of overnight. But I think we may be in a pocket where we're going into where there's actually a lot more kind of upside in regards to kind of Aussie kind of assets. So just kind of food for thought there. And again, we've seen the positioning on, let's say, stuff like Aussie kind of dollar. And don't get me wrong, I'm not saying that inflation is going to come roaring out of nowhere and the RBA is going to turn hawkish anytime soon. But just saying that what I think is currently kind of consensus now and what I used to be a part of, I don't think is definitely the case kind of anymore or as clean. Sticking with this side of the world, inflation quarterly out of New Zealand, always a key thing. 1.7 is what's expected, 1.5 was previous. We also have some important things like visitor arrivals and milk auction coming through from there. U.S. earnings, again, should also be kind of kicking out, this week, I believe. It tends to be the second week after the end kind of the quarter. So that, again, is always important to kind of see where things are there from an expectations kind of basis. I tend to think that earnings is a little bit of a game that analysts kind of play at the end of the day, but we'll have to kind of wait and see how these things kind of play out at the end of the day. I think the market breaking out to all-time new highs is probably telling us something else, that it's not too worried in regards to kind of economic kind of growth for the next 3 to kind of 6 months, and nor is it too worried kind of about earnings at the end of the day. A lot of Fed speak, so do definitely watch out for that, especially Powell, but also Bullard, who, if you remember, abstained and went for 25 basis point kind of cut last time. We have Japan bank holiday today. We will also have Carney and Kuroda speaking, and I believe they may also be speaking at kind of the same event, so I'm actually not quite too sure why we have different dates out there, but I will check that on the final kind of deck. And again, Beige Book, RBA minutes, and some final CPI figures kind of out of Eurozone will also be key. Before I pass it on to Forrest, let me just kind of highlight, again, this is, again, the most important slide in my world right now. It's, I think, the regime that we're going into, which is a Fed kind of cutting regime. It's one where growth has been managed and it's slowing down. It's now falling off a cliff. And it's also one where I'm calling for a structurally kind of weaker US dollar, which should provide tailwinds for EM and commodities. So again, these are the key kind of high conviction kind of trade views that I personally would think should make sense from high yield to outperform, especially EM assets, precious metals and their proxies, and again, kind of different kind of ways of playing kind of a weaker US dollar, where there's short USD basket and short Euro basket versus other kind of long developed markets, or EM high yielders, BRL, MXN, ruble, ZAR, Zloty, the HUF, as well as also kind of what I call team divergent. So Norway, Canada, Hungary, Poland, and I wonder if maybe at some point, because again, divergent central banks is, again, it goes back to being a relative world. So again, if you are maybe neutral to less kind of dovish, then that could potentially kind of put you kind of there. And it'll be interesting to see if at some point we actually get an RBA or an RBNZ that kind of goes back to this kind of divergent kind of camp as a whole. And with that, let me please pass it over to the next slide and to my colleague.
Hello, everyone. I'm Forrest from GST in Shanghai. No voice? Hello, everyone. Can you hear me?
We can hear you.
Hello. Hey, good. So over the past week, Greater China market was overall quiet, with one exception, that is US dollar against Hongki. So last week, our colleague Raymond in GST in Hong Kong made a great spot on this pair and mentioned some key market drivers behind. And today, I'd like to add more color and context on how to look at this pair. So overall, Hong Kong dollar is pegged with US dollar within the narrow range from 70.75 to 7.85, as you can see from the right-hand side chart. So interestingly, long US dollar against Hongki, it has been the perfect carry trade since 2017, whether it be in banks, trading desks, or hedge fund. There are three major reasons. First, you have low volatility due to the currency-bound foreign exchange system, and you have capital gain from with spot went up from the 70.75 to the 70.85. And most importantly, you have the positive carry. For positive carry, there are two major reasons. First, it goes along with the US dollar rate hike cycle. And second, the Hongki has been the founding currency, as evident in the negative Tom-Next swap points most of the time. And the major downside for this carry trade has historically been the Hongki funding squeeze. This be the key downside risk. As you can see from the right-hand side chart as well, there are two major funding squeeze scenarios, as I have pointed out. One is the IPO funding lockup. One major example has been the China Literature IPO back in 2017 in November. And another major driver has been the liquidity objection from the Hong Kong Monetary Authority, which has been the major cases since 2018. As you can see, the funding volatility has been increasingly higher and higher in recent years. Right now, we got another tailwind for Hongki, US dollar against Hongki to extend its recovery. Over the weekend, we have Budweiser Brewing APAC canceled its IPO on Hong Kong Exchange. And originally, it planned IPO on this Friday on July 19 with funding size around 9 billion US dollar or 76 Hong Kong dollar. The major reasons behind has been the valuation. Based on the local media report, the investor feel that the valuation has been too high, and some long-term funds has exit this IPO subscription, trying to suppress the valuation. But overall, this IPO event will cause this pair to drive recovery higher overall. That's it for Greater China part.
Awesome. Thanks, Forrest. So just moving on, we only have a few slides this week. Again, just keeping it simple. It's the same thing that we're going to be talking about until we get some U.S.-China volatility kind of flaring up or something else going on the Trump side of things. Again, it's all about DXY. This is all weekly charts unless stated otherwise. It's all about breaking this big level on the 96 kind of side, to be honest, to see if my thesis on a weaker kind of US dollar is coming through. Of course, it still remains clear that the purest way of playing the Fed cutting regime cycle that I'm talking about is still through kind of rates and bonds. So just kind of bear that in mind. The dollar short does have its own kind of complications. And at the end of the day, I actually think stuff like short Euro Noki or short let's say Swissy Noki or something like that from a long-term kind of perspective, has better kind of convexity, and it doesn't have that risk of risk off potentially from some kind of unseen scenario where a US dollar would kind of get bid as a whole. This here is dollar yen. As we said, that kind of 108.5 level was really kind of a hard level to kind of break up above. We got, I believe, to 108.99 before being brutally kind of hit kind of back. So kudos to those that kind of played that on the short side. This here's gold. Again, that 1380 to 1400 should be fairly good levels to kind of resist. I think here we are just loading up for the next big kind of move higher. The key level is over here, which basically should be about 1342-ish, and that was off the top of my head, that should be around kind of June 18th before that kind of pivotal Fed meeting, so to speak. So this to me is the most important part if I was a big kind of structural bull, or if I was someone that was looking kind of for a structural kind of short in, let's say, gold. Going back and breaking this, I think would be kind of very kind of critical in regards to kind of changing the timing and kind of the outlook. On silver, again, it's more close to kind of 1480. That 1490 to 1500 has been a pretty good kind of fishing level for longs. And the last slide here is just showing you what I've been talking about on the steepeners. I think we may be starting to kind of see that effect kind of coming through, and you can see, as I said previously, I think it's an easy move to kind of 50 bips, 75, and even 100. And actually, you can't quite see it on this chart, but once the steepening starts, it tends to be very dramatic and very kind of quickly. Happy to send. I'll actually put in a longer term chart that takes a few cycles into account. So it'll take kind of GFC, and more importantly, I think kind of early kind of .com. You'll see how kind of quickly this can kind of move at the end of the day. And if you don't already kind of know how to set this up, do feel free to reach out to someone from the global sales trading team, Forrest or myself. But at the end of the day, steepeners, you're long, basically the short end of the curve. You're short kind of the long end of the curve, and you're basically looking for an outperformance on the short end of kind of the curve. And when I say that, I'm talking about the actual individual underlying kind of bond price, not the yields, obviously, which is kind of the reversal kind of that. So that is it for this week. This here is just S&P kind of breaking up higher, new highs. I think that is kind of what it is. And we will be back again next week. Wishing everyone a very profitable week up ahead. Stay growing, stay safe, stay healthy, stay lucky, and all the best.